All right, Warren Buffett publishing his annual letter to Berkshire Hathaway shareholders this weekend. In his latest entry into the 60-plus year tradition, the so-called Oracle of Omaha preaching the merits of reinvestment, writing, quote, "The power of compounding your money inside a successful business for a long time is nearly unmatched in capitalism." Joining us now to discuss a little bit more about that and also what else we heard from Buffett over the week, I want to bring in Bill Smead, Smead Capital Management Chief Investment Officer. Bill, it's great to see you again. So certainly no shortage of lines that we could pick out here from the shareholder letter over the weekend. Share buybacks, taxes, earnings, long-term optimism here on the U.S. economy, just to name a few. Just first, your takeaway from the shareholder letter that we just got.
Well, we thought it was a great letter. And one of the things was he said, he makes an incredibly important decision on average once every 5 years. In a 60-year stretch, he came up with about 12 investments that made all the difference for him, which you compare that to what most people do and what most of your watchers and most of the behavior of investors in the United States, and they change their stocks about as often as they change their clothes.
Bill, great to see you here today. And you and I have talked about this at webinars generally surrounding Warren Buffett's releases of the annual shareholder letter in years past. And if we're on this schedule, let's see, a dozen good business ideas once every 60 years, or every 60 years, that's about one great idea once every 5 years. Do they still have it? Munger and Buffett, are they still executing?
Yeah, the reason for that is they got very large, and that limited what they could do, right? They have to do things in a very, very large way. When in the first 25 years, Buffett was picking stocks, he had a huge information advantage over everyone else. And the education he got from Ben Graham, who was an excellent buyer of 50-cent dollars. So what Munger helped him realize in See's Candy and brands is that as you manage very, very large amounts of capital, you're going to be limited in the number of good ideas that are available to you. If Buffett was running $10 billion, he could have just gone out in the spring of 2020 and had a Ben Graham delight session. But instead, he had $120 billion and has looked for things like Oxy and Chevron to put it in based on their view of the next 10 years.
And Bill, you and I have also talked about some of the secular tailwinds benefiting certain industries. You take a look at millennials, and with the continued demand we expected them to have for housing over the next decade, you can tie oil into some secular themes. They're just wondering how you're seeing Buffett play out in the 2020s and his style of investing here.
That's a great question. Buffett mentioned that you need to be a lifelong learner, and when things change, you need to learn and adapt with it. And what he figured out was the railroad industry was going to be dramatically more attractive to him when it was only 4 companies, including the company that he bought, Burlington Northern Santa Fe. We feel that same way about the 3 home builders that we own. That industry has changed dramatically. It used to be a land development business where you put a house on it to turn the lots over, right, to gain the profit out of the lot. Now, in the case of Horton, Lennar, and NVR, the vast majority of the land they build on is developed by someone else, and they're just a home manufacturer. So we find that business incredibly attractive because there's 92 million millennials coming, and now that people have gotten off of their big city, single, expensive apartment routine in the major coastal cities and are spreading themselves out across the country, there's an awful lot of homes to be built.
All right, we got to leave it there, but always glad to have your insights, especially when it surrounds the Warren Buffett annual shareholder letter. Bill Smead, thank you.